Mayuresh, what do you make of this entire flip-flop that we have seen on Polycab, and any initial, sense on the numbers that we have?
Afternoon, Anisha. No, I think the numbers look decent enough. And obviously, I think the kind of scope that the wires and cables business has, unorganized to organized, expectations in terms of export opportunities as well. I think the landscape is pretty robust for the entire sector and companies within this sector as well. So numbers absolutely in line with expectations as far as Q3 is concerned. But to a large extent, I think what is expected to happen in terms of the tax implications is something that the street would like to watch out for. And that will remain as the biggest overhang for the stock from a near to medium term perspective. So I think numbers quite reasonable, quite okay. There are structural tailwinds for the sector. But I think the tax issue is something that will keep the stock, especially in terms of price action, in a range-bound fashion.
All of these FMCG companies is not very enthusing. Part of them are saying that there is sign of rural recovery, but it's not, that visible right now. How should one approach the entire FMCG basket right now?
Being very selective, Anisha, very frankly, because I think a lot of players have, as you alluded to, clearly mentioned that rural recovery might be a little bit more sticky in the next couple of quarters. And that's clearly getting played out in terms of how the volumes have grown for companies which have probably reported numbers. Obviously, I think the kind of inflationary impact that we've seen because of lower rainfall and decrease in discretionary spending, because rural does form a large part of the FMCG volume universe, the volumes are going to be a little bit on the lower side, which means the price effect will also not be seen. If that probably happens, the combination of volume and value growth might be missing over the next couple of quarters. The best case scenario that gets built up for FMCG companies are on two counts. One, in the coming rainy season, I think over the next couple of quarters, if normal monsoons are expected, there can be a healthy growth that can come through in the second half of the next financial year. And the expectations is that input costs should largely remain benign, which means EBITDA margins should see reasonable amount of stability and growth going forward. Valuations have always been on the higher side, and therefore we are being a little bit more selective here. Obviously, the acquisitions done by Tata Consumer are in the right space in terms of what they are expecting the overall volume and value growth to happen over the next few years. But I think within this space, I think packaged foods, QSR companies might be a little bit better off compared to the core FMCG companies, at least at this point.
What's the strategy for investors who are fully invested right now? Would you say at least take some chips off the table, be a little cautious?
That might be the strategy, Aisha. And I think being a little bit more selective does warrant attention in these markets. Any decline that comes through, and if there is no substantial breach of 21,050, which is a 10-weekly moving as we see it at MarketSmith India, I think that can be a good buying opportunity from those levels. So I think selective spaces like energy as an example, probably looking at retail as an example, some names in logistics, which in my opinion can do extremely well over the next couple of years. And few of the PSU banks, I think a few of these spaces, if the market does decline and give an opportunity, look very, very interesting from an earnings perspective over the next 12 to 24 months.